So folks, I am here today speaking in front of the Startup Incubator and the entire cheering committee. And with some great trepidation, I'm going to talk on my topic today, which is do not do a startup. Just buy a business and get going quickly. So moving right along, why am I saying that you should not do a startup? Firstly, as we all know, we take on massive risk when doing a startup, go through high burn rates and often lose our shirts. Or hopefully, since we are all still standing here, we haven't lost our shirts. But the poor new entrepreneurs and people out of the startup incubator, they are going to be losing their shirts. So let's warn them against this. So I know I'm talking to a very skilled group over here, which is all of us, and hopefully I'm in that too. That we all have a lot of experience in startups and have the bruises to show for them. And then we have an expert like JJ. So I'm sure he can do some attacks on me before everybody beats me up. Haha. Now, in my work, I do a lot of coaching of Cal State Fullerton entrepreneurship students, and I also consult with a lot of local businesses. So in my work, I see every day that entrepreneurs bet the majority of their wealth against an untested idea that they think could make money, not realizing the odds against that, which are massive. So now I want to talk about the statistics of failures in startups. These are, I'm sure these are not news to anybody, but it bears repeating, and it's very humbling for anybody who's thinking of doing a startup. So of all the startups that happen, 20% fail within the first year and 50% fail by year 5. What's more, only 10% survive in the long run. Furthermore, only 40% of startups make money, and just 30% struggle to break even. Moving on. So now, obviously, I want to, whatever I'm saying about the startups, I would request you to look at it through the lens of, okay, so we're doing a startup versus buying a running, ready to go business. So now I'm going to show you the typical returns from buying a business. Excuse me, there are going to be some heavy numbers here, but I'm going to try to make it as simple as possible. And I'm going to use round numbers for simplicity for everybody to follow. Okay, so when there's a business for sale, these are the key parameters that are listed. So if you look at the black band on top, look on the top extreme left, which it says EBITDA. EBITDA is a measure of the free cash flow that benefits the existing or future owner of a business. So in this, I'm taking an example in which this is the EBITDA is $263,000. And if you look on the top right, the price is a $1 million business, to keep it in round figures. And if you see in the middle of that band, you'll see multiple of 3.8. So businesses are typically valued based on the annual income. And then they, in the market, what they do is they apply a price earnings multiple to it. So in this case, it's the EBITDA is $263,000, and the seller has probably applied a 3.8 multiplier to that to give it the price of $1 million. Nice round figure. Okay, so now the financing of this business, which is typical out there and which I am in favor of, the financing is done debt versus equity, 70% debt and 30% equity. So if you move right along that to the right of that column, you see 700,000 is debt and $300,000 is equity. So now, as we do some calculations, we are going to try to recast these financials in a way that applies to us. Like if I'm to take over this business next week, what will I really get out of that? Is it going to be that 263,000 number? Probably not, because just bear with me for a minute here. Because what's going to happen is I'll start out with the EBITDA number of $263,000. And then the first thing I would do is to make my calculation more feasible. The first thing I would do is take my overall new debt, $700,000, and in the first year I'm going to have interest. So I'm assuming here the interest will be 5% per annum, and the interest is $35,000. And the next big thing that we account for in recasting these financials is contingencies. Contingencies covers things like unforeseen circumstances, obviously, but also there are typically, I like to provide for some income drop-offs when the ownership changes. So the old owner goes with his expertise and with his contacts and so forth, and we take over without having all those industry expert information. So we come in as a new owner, and there'll be a little bit of an income drop-off. So between that and accounting for unforeseen circumstances, I'll call that overall contingencies, and I'll put 30% for that. 30% of the income level. So $263,000 times 30%, which will give you $79,000 over there. Everybody with me so far?
Yes.
Okay. So basically you start out with the income of $263,000. Then you deduct the first year's interest of $35,000. Then you deduct the 30% contingencies, which is $79,000. And then if you see that label, it says the EBITDA post-acquisition. In other words, we started with the EBITDA that's existing for this business, for the current seller, and we took it over, and then we have to account for additional expenses and provisions for unforeseen circumstances and so forth. So after doing all that, the number comes to $149,000 for the post-acquisition EBITDA. And lo and behold, that is a return on equity of 49.7%. And that number is calculated very simply because it's the new return on equity. The new return is $149,000 divided by the equity of $300,000. So that gives you pretty much 50%. Now, the first question, after I get done talking up the buying of a business, the first question I'm always asked is, well, but how is a new entrepreneur supposed to fund the purchase of a business? And for our purposes, I would like to take our candidate, entrepreneur candidate, as a person who's either fresh out of Halo School and starting up a business through the incubator, or somebody who's a layman entrepreneur out there who's going to do a startup. And I count the opportunity cost of those people as around $75,000 to $80,000 a year in potential income that they will get without having a startup or buying a business. So that was just an aside. But carrying on with this, I'm going to take you through funding a new business. Keep in mind that a person who's going to do a startup is also going to start spending a lot of money. They have to collect a good amount of money. Then they just seed the business, and then they start paying. Typically for these small startups, they'll be paying money to cover losses every month. So that's the burn rate. So in this, let's get into the details of this. In this example, we are going to use a business which has a purchase price of $700,000. Okay. Please stop me if I'm going too fast. And please feel free to ask me questions at the end of each slide. So we keep being clean and smooth throughout the thing. And of course, at the end, I'm going to give you plenty of time for questions and answers. So you'll have the double opportunity, hopefully. So getting back to this, the business that we're going to assume is $700,000. Now, we are following a theme of financing a business but with 30% of equity and 70% debt. So in this case, 30% of equity means that's $210,000. Everybody with me so far?
Got it.
Okay. So total equity we need for this business is $210,000, right? And so that's item one in collecting the funds. Remember, there are three sources. So item one is the overall equity need, which is $210,000. No, sorry, that is the overall equity. Below that, you see item one, which is the equity from the sponsor or the entrepreneur. And I'm going to be really tough here, and I'm going to say that the entrepreneur has to save up money. Wild idea. But because if you talk to any budding entrepreneur out there, they'll say, oh, how am I supposed to collect $110,000? I'm not that rich. But my answer to that is that, look, any entrepreneur, as we all know, they need to be very hungry and very eager and very disciplined to come up with the money and come up with everything else that they need to get into entrepreneurship and make a go of it. So the first source of equity is the sponsor, the owner, the new owner. And that I've taken as 55% of the total equity. And that comes to $110,000. So you know, there's always that controversy because people always ask me, how are fresh graduates going to collect this much money? And my answer to that is, as I discussed just a couple of minutes ago, if you take the opportunity cost or market value as an employee of the person that we are going to think about. Let's say it's a new graduate of the Mayhill School and the incubator, startup incubator. So I'm going to assume that they get paid right out of school. If they get a good job, they'll get paid around $80,000 a year. And from that, I would, if this person was my mentee, I would insist that, look, you want to buy a business, just get very organized and disciplined, save money. As you graduate out of school, don't raise your standard of living very high, like most people do. Just stay with the same standard of living and save money, put away money every year. And that would be my estimate of what can be done with that is around $27,500. So over 4 years, that comes to $110,000. So lo and behold, we have the sponsor's equity there. And I'm not saying that this is easy. I know it's going to be hard for whoever is supposed to do this. But any entrepreneur needs to be really hungry. And I'm sure you guys all agree with that. All my experts here and the experienced people. So now I want to go forward and bring this into a real world, which is I recently looked up businesses for sale on a site which is of a large broker in the industry. And I found a guinea pig of a business that I would like to work through with you. So the business is listed by Sunbelt Business Brokers of Fullerton. Now, this is, if you go to their website, they have hundreds of businesses listed for sale there. And this is their Fullerton office. So they have this business, which is described as this. It's a commercial electrical contractor with lots of service agreements, contracts out there. So now this business is, again, if I draw your attention to the black band on top, if you start again at the top left, the existing EBITDA that they're advertising is $422,932. And they've applied a multiple, price earnings multiple of 4.7 to get them to the price that they're asking of $1,972,000. So this is a business that we are saying that, okay, we might have an opportunity to buy this business. Again, like this is almost a $2 million business, but based on how much money one can accumulate, one would find price points for a business to buy that are feasible. It could be $300,000, $700,000, $1 million. So going right through this example again, example of an actual business that's for sale out there, the electrical contractor. So as we've been following the theme, I would finance it with debt of 30%, debt of 70% and equity of 30%. So the first adjustment you'll do to the existing EBITDA figure will be to apply the 5% interest on the debt. Applying that gets us to outgoing cash flow of $69,020. And then, as before, if you recall, we had allowed for contingencies, and we are doing the same thing, 30% here. And by the way, that's an extremely conservative scenario. Most people wouldn't, but I apply that to be a little bit extra sure of my numbers. So the 30% comes to $126,880. And finally, after running all these numbers through, you come up with a new EBITDA, which is post-acquisition, of $227,000. And that gives us a whopping return of 38.4%. Any questions so far?
Adil, we have a question in the chat. Kervin's asked, what metric would you consider before buying a business?
Metric. I'm going to come to that. I'm just about to talk about the steps to successfully buying a business. And then I'm going to talk about how do you identify a good business to buy. So these are about to come in the next 2 slides.
Great, thank you.
Okay.
So moving right along, I'm going to talk about the 7 steps to successfully buy a business. Sorry, I'm having a bit of trouble with my windows. They're becoming a bit small and then a bit big, but I'm ready to move along now. So the first step to being successful at an acquisition would be to secure and verify your funding. Number 2 would be identifying promising industries and products. So just get a feel for what's out there, what things interest you more, and what areas you have space expertise. If you've had this in your previous background or you have some training or education in that, you might want to give that additional weight. Then define the return you seek from your new business. Next, I would say that you have to generate deal flow. And deal flow means that you should be able to see the maximum number of listings of businesses for sale that's possible. So that's usually done through, there are a lot of online listings through Google and on, and there are listing websites. But what it comes down to is that the businesses are getting listed by a broker who is usually the seller's broker. Now, what I've done in the past is I've retained a broker myself as an acquirer. So it's a buyer's broker. And in that case, I get the broker working for me and looking through all the numbers and putting the due diligence through all the numbers from my point of view, because they're representing me. Next, I would say you need to assemble a team of experts. In the business buying process, these are the people you would really need in your team. So you don't get them at the last minute. As you prepare to do a search for a business and buy a business, you need these people. It starts with having a good attorney, and that attorney will write up your acquisition contract when the time comes. And then you should check the customer concentration, that large customers don't account for too much of the sales of the business. Meaning that if a few people cancel working with you, then it's not like your whole business is shaking up. Identifying a business. Give me a second, I'm coming to this. Okay, so this slide is about identify a business to buy. Can everybody see? Is everybody with me now?
Mm-hmm.
Okay.
Yeah.
So we went through the steps of buying the right business. Now I want to introduce you to how to identify the right business to buy. So first thing I would always check is that the business is minimally dependent on the owner. Let's remember, folks, that we are talking about small businesses here, and they're typically run by one owner who operates as a CEO and chief of everything. And so typically what you'll find in a small business, which is like listed for, let's say for sale around in the 500,000 to the $2 million mark, you'll have one owner who's running everything. That person has all the contacts with the key customers, with the key vendors. That person also has the industry expertise. So if you have a more mature business, it should have a reasonably good tier of management people below the owner, which means that once the owner goes away, the existing people along with you would be able to run the business well enough that it could continue to make money on an upgoing trajectory. And as I was saying earlier, check the customer concentration. Specifically, this says that the top 3 customers should not account for more than 5% of your total sales. And again, as I was saying, that would mean that if one of those 3 customers stops doing business with you, then your business will totally shake up. And finally, I want to put a challenge to you. Given all this information and metrics that I've shown you today, why on earth would you do a startup? Thank you. I'll take questions now.
Hey, Nancy, as a longtime SBA lender, what are some of the things that the lender would take into perspective in the scenarios here that Adil has described?
Okay, a couple different things. So for those of you who don't know me, I did SBA loans for well over 30 years, and I've done everything from startups, business expansions, buying businesses, and a lot of what you say, Adil, is true and correct about buying a business that's ongoing. The most important thing when you do that also is like sellers generally, the worst thing is they don't have financial statements. They only do tax returns at the end of the year. So it's really important to tell them they need to start getting on it and spending money on doing those monthly financial statements. So you and your team of who's buying the business can start analyzing what you need to in detail, as well as the lender is going to do this. So that's the most common thing that holds up deals, is that they just don't have proper financial statements. And you're putting your cash in to this and you're getting a loan that you have to pay back. So you want to make sure you have very good financials. So it really,
you know better than most people that the numbers on the tax returns have to be put through a very detailed analysis to come to this EBITDA or the free cash flow that benefits the owner. So I'm assuming that you carefully check those add backs and the adjustments that a potential buyer is doing when they present it to you.
correct. And we don't, so like business brokers, they give you like this huge long list of all these add backs, and they could be true and correct, but lenders looking at these, we don't take into account all of those add backs because, for example, you're going to be taking a salary out of the business. You're going to be using a cell phone. So it's just real important to know. And I always say this to everybody, even if you get a small loan, get a loan so you have another set of eyes looking at this transaction, because you buying the business and your accountant and attorney are going to do a different set of due diligence than a lender does. So you never want to just rely upon a lender's due diligence, because we're looking at a really different perspective.
Right. Okay. But Nancy, tell me if this is correct. I'm a great advocate of people getting SBA loans, small business people. And I tell them that, look, that the new entrepreneurs are going to say, look, I don't have a lot of credit. And I tell them that, look, the SBA loan program is much more flexible than your regular commercial loan. So it's
That
a
is
much more
correct.
attractive avenue.
Yeah. That's very correct. So the most important thing that you can do if you're going to be, whether you're starting up a business or buying one, is make sure your FICO score is in good order. It's better to have a less amount of credit than it is to have bad credit. Make sure that your resume of experience matches the type of business that you're going to go into, or you have translatable type of experience, because that's going to be real important to a lender as well as to you when you're running this next business. If it's not you that has that exact experience, who on your team does have that exact experience? So really,
Nancy, as talking candidly, I'm sorry, I didn't mean to interrupt.
no problem.
Talking candidly, you're a lender and I'm a potential borrower. And so it's usually quite possible to find a way that you can fit some of your expertise and experience into what's needed in a particular business. Like, for example, I'm a finance MBA, and most businesses need strong management and strong finance. So I usually will profile that, spin it in a very positive way.
Mm-hmm.
And a lot of what I've drawn on today is based on a business that I bought myself 20 years ago. It's called ProStar Mechanical Services. It's a boiler and mechanical facility equipment company for hotels. So I've had it for 20 years and it's given me a great return over that time. We've been blessed and it's still running. And the return over a 10-year time horizon has been around 34%, which is roughly in line with the numbers I was showing you earlier.
Mm-hmm.
So for this business, the business is a mechanical contractor, which also has a lot of inventory of mechanical equipment and so forth. So in my history, I've done a lot of business selling hardware and other mechanical stuff to business B2B customers. So I profile that, and these are all legitimate things, by the way. I'm not asking anybody to make up things. I'm just saying that spin it in a good way, in a correct way, and take full advantage of where you have your expertise. So for that business, I profiled my experience that I had before. And then, of course, I said, look, like as a finance person, I'm a bit biased, but I said that all business needs financial expertise. So with that, I was able to convince the lender quite easily that, okay, I've got a good enough resume to run this business.
Mm-hmm. It's also important on your resume too, to put like other things besides just, like widget type of things, is to what do you do in your personal life? Because people tend to be in charge of things in their personal life, whether it's a charity that they're working for or the church. It makes you look like a whole person, and it adds some sparkle and pizzazz to your resume of experience. And then just to jump over on the business valuation side, is that any SBA lender, when you go to them, they're going to do their cash flow analysis and things like that, and ask a lot of questions, look at your business plan and your projections. They'll all ask you for projections, which if you hire somebody to do that, you really need to have worked with them and understand it so you can be answering the questions to the lender, because it helps the lender build confidence in you that you'll be able to run the business. And all of that, the 3 years of tax returns, the projections that are asked for the first couple of years, a business valuation will be done by the lender if they determine that they believe that this could be a loan that would be approved in loan committee. Once you get a commitment letter, there's a 2-week business valuation period that goes on by a third independent party, and it generally costs about $2,500. So again, that's another set of eyes that are looking at this business before you buy it. So that's why you see escrows for businesses usually 60 or 90 days, because of all the due diligence that you want to go through before you actually own this new business. So that's helpful to plan that because business brokers, they try and just push and shove and rush things along. This is not a home loan that you get done in 30 days. This is a business loan that has a lot of moving parts.
Right.
So
And also my experience with business brokers is that they strongly are on the seller side. They represent the seller, and all kinds of declarations are made and expectations, very blue sky expectations about how much income and how much potential the business has and so forth. So one needs to take that information with a pinch of salt and do one's own analysis to come up with the most realistic projections of what the new owner can benefit by.
correct.
I have a friend who's a business broker, and he confided in me that about 75% of the businesses that are for sale don't sell. And it begs the question, well, why is that? Well, they're overpriced. And so many times the seller's expectations are much higher than what the market's gonna offer. Another dynamic with the seller is probably this is the only time in their life that they've sold a business. And it's a very emotional decision. So when you talk to that current owner, they confuse themselves with the business because this is their baby. They built it up over 15, 20, 25 years. And so selling to the right buyer is emotionally important to the seller many times. It's not just money. Although there can be many reasons for the seller wanting to sell or having to sell. You'll probably smile as I say this, Nancy, but invariably the owner is late in life. There could be a tragedy at play. There could be illness that triggers the need to sell now.
Or death.
Right. Or divorce. It's a common one that triggers it. And so the motivation of the seller will greatly impact their desire, their ability to negotiate. So a lot of variables at play. And you're absolutely right, Nancy. Many of these small businesses have been a source of lifestyle for the owner. So, it's a $2 million business and they have a $200,000 RV. Well, that RV is actually owned by the company or paid for by the company. And they're every summer they go to Paris and that's paid by the company. So there's some reconstructed earnings that are very tricky to look into when you're purchasing a small business like that.
Correct.
So when I took over my business, one of those kind of things was that there was a condo in Del Mar, in the beautiful upscale area of Del Mar. There was a condo which had a beautiful view of the ocean, and that was being charged to the business.
Exactly. And, the tax code kind of allows for that. And depending on the owner, they'll take advantage of some of those different aspects. So you really have to be analytical, almost clinical, like a surgeon, as you dive into the financials and try to understand it. The other phenomena that I've witnessed is the small business owners sometimes have two sets of books. One which is reported to the IRS, and the other which is the real business. And maybe Nancy, I speak out of school. You may not have seen that, but in my consulting work with small business, I've been stunned at the true stories. So
I have seen that, and here's the bottom line is in SBA lending, we have to go by the tax returns. So if you have a seller that is saying all these things, they need to present verifiable information that we can see that the business has been paying, like that mortgage on that condo. There's some way, shape, or form they can give that evidence. But if it's a lot of things like, oh, I went to Costco every weekend and spent $500, that's not going to be an add back. So it has to be something that's realistic. It's interesting what we can work with, but the seller has to be very open and very transparent to you as well as to us and the business valuation expert.
So another source of financing is the seller themselves, by the way.
Mhm.
Oftentimes, they want to sell. They want to sell to the right person that'll carry on the legacy. And so carrying back a note would not be unusual, as well as an earnout on the note itself. So you keep the previous owner involved over 1, 2, or 3 years. And with progress payments that or maybe the note will be paid off, and then you transition the business to that new owner operator. And that way there's skin in the game to make sure that none of the clients scatter, the customers scatter during the transaction.
My approach to this is pay the old owner a certain amount of money, like quote unquote consulting fees, or he can continue to be a salesperson or a marketing person for you. But as soon as practicable, you let them go, cut them loose.
I agree, but for continuity purposes, so here's a simple example. Many years ago, my dad bought an Italian restaurant. Sunday night, he bought a pizza. Monday night, he bought the pizza parlor. Okay. Now, my dad was a jack of all trades. Did he know how to run that place? Well, not exactly. So the seller did hang around for a few months and help my dad and the family, including me, learn how to run that shop. So there is, but at some point in time, there's diminishing returns that you need to get the old owner out of the shop and get on with the new.
Well, from an SBA perspective, the seller cannot stay on beyond 1 year. So it can only be up to 1 year.
Okay.
And from an SBA perspective, there can't be an earnout like that. The price is the price, and that's what's closed on the escrow.
Because the earnouts are very common in the sale of a business. So
well, and I could tell you on ones that I worked on, they come to me with those agreements, but we have to say, can't do it. You need to renegotiate and come back to us if you want an SBA loan, because they need to be, that seller needs to be done and gone within 1 year or less. It's a plus if the seller will stay on for a year, but not, so if they're going to do that earnout and all that, then they need to have the seller do all of the financing, and the seller is probably going to ask for more cash in, and sellers do ask for collateral just like lenders do. So there's many ways to do a deal. And I always think the deal screams out what type of financing it needs. It'll scream SBA loan because it's eligible for it and we can put the pieces together. Or it'll scream the seller has to carry the financing themselves. And then after 3 years of ownership, meaning that the buyer has 3 years of tax returns showing increasing and revenues and profitability, they can come and get an SBA loan to pay off that seller carryback note. So there's many ways to do it. And that's why when you find an SBA lender, you want to work with one that has experience in doing all this and that's user-friendly, because you're going to be with them for a long time. And SBA loans to buy a business are 10 years fully amortized. And if you have any hiccup at all in that 10 years, the SBA loan, you go to the servicing department and say, oh, this COVID thing is killing me here, you know. And so there's a lot of things that an SBA lender can do to help that you'll never see on a conventional loan. So those are
really important points. Thanks for raising them over here.
Mm-hmm.
Okay, any other questions, comments?
I have a question, and and Nancy, maybe you, but Adil, you know, or anybody else in the audience. So let's say I'm a employee and I'm make $100,000 and I decide I want to buy a business. How much of that, what would that qualify me for? Is it like if you have a current income stream of say 100,000, and then that would qualify you for a certain amount of the business of qualifying getting a loan. And is there like a number there? Because I know when you buy a house, they usually look at your income stream to determine if you're going to buy a house. And then on top of that, I've known I've also been involved in buying up a rental property. And usually what they do is they add on the rental monies, and then they'll say, well, you can qualify for a bigger loan because you're buying an income stream. So maybe how does that work? How much can you qualify for?
You would actually just work back. Say you could save $100,000. Is that an income you're talking about, or savings?
Yeah. If that was my salary, or would it really just depend on how much I have saved?
If I was your coach, I would make it a requirement that you please be disciplined enough and save $40,000 a year. Do that for 3-4 years, and you're into $120,000, $150,000. And now you have a good seed fund to start up the search for buying a business.
So another way to look, oh, go ahead. Well, another way to look at that question too is, because I see what you're saying. So in lending, we're looking at that business cash flow. So that 100,000, it's about you getting your down payment. But the most important thing to us is the business cash flow that you're buying, and then what's your personal financial statement and credit reports say that you're spending. So we need to make sure that business that you're buying has enough money to pay for the loan and pay for your life expenses that you have at this point in time.
Yeah, one of the most important things that I put in my talk about this is the importance of doing proper, thorough due diligence, which is having a CPA completely audit the previous owner's books, the current and fixed assets and liabilities, and all income and EBITDA figures, which start from the income tax returns, like you said, Nancy, and then put proper add backs, make sure all things that should be charged to the business are being charged. So once you run that through the ringer, then you're able to come up with what you need for the bank.
So should you start? I'm sorry.
Go ahead.
Should you start the process of securing a loan first for, let's say you have an idea, you want to buy a business that's $1 million, or should you start looking for the business first? Just like when you pre-qualify for a home loan, or is it different?
Well, I always had, where I've done this, I've always had an interactive dialogue with my lender. So I figure out, look, I've got this much equity. These are my cash inflows personally, and I want to buy a business. So let's figure out how much I can borrow. Does that answer your question?
Yes, sir. Thank you.
Anything else I can address?
How far back should you be able to look into their books for how many years to see if the business is on the decline or if it's actually gaining momentum? And at what stage would you consider buying a business? You say it's extremely risky to start a startup. So what age of a business would you consider, or what maturity?
First part of your question was about how far back do you want to look? Mm-hmm. So a simple answer from my point of view is I want to look at the last 3 years results and the last 5 years results. Now that's not too long. It's not 10 or 20 years, which is like all the conditions might have changed by then. And so I take this, let's say last 5 years numbers, and then I do my recasting of the financial statement. And then I like to project for the next 3 years and next 5 years as well. And then of course you can, I don't want to make this too complicated, but you basically are able to do an internal rate of return based on what cash flows coming in are going to be and what cash flows going out will be as well. So that ends up giving you a very clear and accurate idea of where the business really stands.
Adil, I had another thought, and that is, think about it. So you're buying a business, hopefully one that has been successful and has the prospect of having continued success. The question becomes, if you remove that owner operator out of the equation and you
Yeah.
put yourself in that role,
Yeah.
are you a good fit? Because you know, sometimes the success of a business that's for sale is clearly built around the skills, the charisma, the experience of that seller, right? And so are you similar to that person? And could you take that business and take it to the next level, right? So using the restaurant example of my father, he had a background as a cook in restaurants years and years ago. So he was confident that he could pick it up and take it to the next level. Now, if that was an automobile repair shop and you don't know which end of a wrench to use,
Right.
you might second guess your motivations, right?
JJ, we always say that entrepreneurs are brave and courageous and disciplined and so forth. And that kind of entrepreneur is going to be able to convince themselves or their lender or their other investors that they are a good fit somehow. I mean, if you look at any business, you can name me any business. For you, for example, the restaurant business might be, and I'm assuming maybe your dad did it that way, that, okay, what's my connection with running a restaurant? I have been to Italy a bunch of times and I've got an appreciation for their food. Or I've been middle manager or upper manager at these two businesses. Or in my case, I would say, oh, I've got the expertise of finance, and there's a real estate portion to this business as well. And I bet I could convince somebody like Nancy about this.
So those are
no offense, Nancy.
You're right. So, but you want to optimize the purchase
Yes.
For growth. So the more you have in common in a way with that seller, to a degree, I would say, the more likelihood you're going to be able to take it to the next level. So just a comment.
Yeah.
Now, what
Also,
about
while we on this topic, when it's possible, I advocate that you get the seller to carry back some of the amount. Instead of taking $700,000 all SBA loan, if you can get the seller to take part of that, let's say $350,000, the seller is going to carry a note, which is for deferred payment. Over a period of time, you'll pay them $350,000, and then your SBA loan is also $350,000. Now, one of the positive things about that is that the previous owner has some ongoing skin in the game. And so they will cooperate with you. They'll do their advisory role as much as possible in the right way, because they have a vested interest in you, since they've given you the loan to partially buy the business.
How long can that carry back period be? Because I thought Nancy said it's limited when you go SBA.
Well, it's different. So the seller staying on to help can only be up to a year. So if there's a seller carryback note, the term of that note has to be the same as the term of the SBA loan, which the SBA loan is 10 years. So the seller carryback note has to be paid over 10 years, has to be a reasonable rate of interest, and we'll ask them for a sample of the note, because they want to make sure the terms are reasonable. Because think about it, you're the buyer of the business and the lender, we're on the same side of the desk. The seller's on the other side of the desk. So lenders do get a little bossy because we're trying to fit the SBA guidelines and make sure it's reasonable. So they, I know prime rate is pretty high right now, but the rate has to be similar or less, but the term can't be less than 10 years. It can say no prepayment penalty in that note. And so therefore, the buyer, when you take over, I would highly recommend not to pay it off in the first 3 years, just make the monthly interest or principal and interest payments, because that first 3 years, you're getting used to this business. So after that, and you feel really comfortable, if you want to, you can pay more towards the note and pay them off earlier or not, but it has to be 10 years.
Nancy, correct me if I'm wrong, but I've never seen any of these seller carryback notes to be 10 years. I've seen them almost always under 5 years.
Well, it just depends. So like larger deals, they really need that 10-year term because we're trying to do the debt service coverage ratio on the lender side. And that's the times you see lenders get a little bossy is we're trying to make the deal work from a debt service coverage ratio. So that's why if we say this has to be 10 years, but it could say no prepayment penalty, that's helping both sides. But you're right, in the past, gosh, up until about, I would say in the last almost 10 years, the notes tend to be near a 10-year term because the cash flow, we can't add all those add backs that the business brokers put in. So it's just real important, to think of it from that perspective.
Also, these are small businesses and the seller doesn't want to be on the hook for a very long time. For a quick story, in my case, what happened is my seller, I had agreed on an advisory fee for him, let's say $5,000 or $10,000 a month. And what happened is I had a confidentiality agreement with him, which is a parallel to non-compete. Now, non-competes are not really legal, but it was just a way of getting partial non-compete term in that transaction. And within the first few months, the seller started to sell a product that was covered under the non-compete or non-declaration. And I still owed him a large amount of money. I owed him $280,000. And then I sued him for $500,000. And so to get the funds, we were able to just deduct from the part that I still owed him. So the seller, my point in that was, I digress, but the seller doesn't want to give the loans for too long, like a more than 3 or 5 year term, because businesses are very volatile. If I'm a seller, I'm going to think, hey, what if the new owner cannot run the business properly and the income drops substantially? Then my own loan is going to be at risk.
Yeah, and these are all deal points that are negotiable. You brought up the word non-compete, and SBA lending, the non-compete clause needs to be a minimum of 5 years. And that's very traditional to see 5 years of a non-compete.
But I believe in California, there is no non-compete is not valid in California. So again, I'm telling you that I had a very good lawyer and he drew it up as a confidentiality agreement.
So
meaning if you ever circumvent any of the terms of the confidentiality, it's as if you're doing something competitive.
So non-competes in California are legal. The issue is the enforceability of them in the courts.
Okay, they're legal.
There's a legal term called consideration.
Yes.
Right? So if you sign a non-compete, it depends what the exchange value is in that non-compete. Generally, the courts are employee friendly rather than company friendly on a non-compete. You go to the state of New York, they can be ironclad. So it is a state by state issue. So Nancy, I know you have opinions on this as well. So
well, and the SBA is a federal loan, so these things can all be nice and fine, but the bottom line is if they want an SBA loan, we have to follow the federal guidelines of the standard operating procedure.
that's very pertinent information. Thank you. Thank you. I appreciate that.
As far as buying a business, should you do it as an individual, an LLC, or a different structure?
I think the key point, I mean, I'm not a lawyer or a CPA, but the key point is the vehicle that you buy it in. Do you buy just the asset or do you buy the whole corporation? And corporation purchase comes with a few potential vulnerabilities, like you'll be taking over many liabilities that would not have been pointed out very clearly upfront. Whereas if you just buy the asset, there's no surrounding liability or obligations that could go with it, that could go with the whole corporation.
This is where you need an attorney.
Yes, yes.
Okay. Thank you.
Now, what about in a case where a business is declining? Let's say, for example, there's been a new owner, the business starts to decline, and that owner says, well, you know, I just didn't have the time or whatever reason, or maybe I lost a key employee, but the business should be of this value and they want to sell it for the higher price, but currently they recognize that they're not the right fit for the business, and therefore that's why it's been declining. Would they sell it?
The seller gets sued. If the seller, if there's a thought process that says the seller has blown out their numbers more than correct, then the new owner could actually sue and get compensation from the old owner.
Okay. And they should probably sell it for the current value, not what it used to be. It's the current.
Right. So that's what I heard out of your question is, so if somebody is willing to buy a business that has declining revenues and that person buying the business feels that it's a valid reason, that's a perfect seller carryback note. And then when the person buying the business gets it up to speed and they have at least 1 year of profitability to show for a loan that they need from an SBA loan, that's when you come and get an SBA.
Sorry. But at the same time, if I see declining results over a period of 3 to 5 years, that listing belongs in the trash bin, straight up.
Unless you could fix it. Unless you're the one to fix it, and you can buy that at a bottom basement price, right? So instead of $1 million business, you maybe pay 250,000. You go in and reinvent the business, and you take it back up.
Very good point. Yeah.
And I've done plenty of those loans paying off a seller carryback note where exactly that happened. So
is it risky? Yeah, but could you get a higher multiple? Oh, hell yes. Good luck.
Are these considerations the same for brick and mortar as well as an online business, or would there be a different set of considerations?
Well, I'm talking about brick and mortar stuff because that's what I'm more familiar with. In the technology world and online world, I'm sure the valuations are totally different. And maybe JJ can shed some light on that.
Yeah, so this is where you could have a formal valuation of the business done by a valuation professional to assist. But I hear what you're saying about the familiarity of a bricks and mortar business with plant and equipment. On the other hand, you know, the digital businesses, they're easily scaled if they're done properly and if it's the market is a good fit. So
but there's a huge amount of additional risk in those businesses, right? Because they're not backed up by assets, and the level of returns could be very volatile in the sense that it could be many times more than in a normal 3-year trajectory.
Yeah, I don't think I'd argue with you that fact. I think the potential return on investment in the digital businesses could be higher. So higher risk, higher return. So
yes.
Yeah. Back to you, Philip.
Oh, this is. Go ahead, Trang.
Yeah, hi. Thank you for your speech. It's very informative, and also thank you, Nancy and John. Yeah, it's actually very interesting to listen to all of you. I have a question related to how you negotiate the multiple. So basically, I have a case where if I count it, the multiple right now is what the seller is asking is about almost 6, but the market is about 3 to 5. Sorry, 3.5 to 4.5. So what I'm I'm asking right now is like, when you look at the financial statement, what exactly the place that you're looking for to negotiate that?
Are you done with the question? I don't want to, I'm sorry, I'm interrupting.
Yeah, sure,
Go
sure.
ahead. Okay.
Yeah, I just
So-
wonder like what exactly you're looking for in the financial statement or the business activities to negotiate that is going to be too high for the asking price.
Okay.
Yeah, that's my question.
The multiplier that's applied varies very strongly with the industry that you're in, and then the specifics of the business. For example, I was talking earlier about how to identify a good business. One of those things was minimal dependence on owner. And one of the other items towards the bottom was good amount of recurring income. So if there's a good amount of recurring income, that means you're that much more certain that that's going to eventuate.
Right.
So
So actually
that could
the
increase
industry, yeah, sorry.
that could increase the multiplier because that makes the business stronger. And on the other hand, if there's some declining trend or some years where they've just matched previous year's growth, then that would drop the multiplier by quite a bit.
Mm-hmm. Yeah.
And also, lastly, we're talking about small businesses, right? So basically, we're talking of business value and sales of under $2 million. And for those, the common multipliers out there in the market are typically in the range of 3.3 to 4.5%.
Right.
And everything is negotiable.
Yes.
Yeah, because I'm
Which means
looking
get
for
quicker with the
the
Excel sheets.
yeah, because I'm looking for the hotel industry right now where the like it's family owned company, but it's corroborate also with the city.
Yeah.
So some of their premises is rented from the city, something like that.
Mhm.
So yeah, so when I look at it, it's a little bit like too high from the pricing. It seems like they asking like 1,700,000
Yeah.
and the EBITDA is about like 300, yeah, around like
How many
300.
rooms is the hotel?
Sorry,
How many rooms is the hotel?
it's actually not really like a hotel, but it's like a villa.
Okay.
So they rent the whole villa, something like that.
So in
Yeah,
both
so they
cases,
have,
with hotel and hospitality, typically there's a good chunk of real estate action going on. So a lot of the purchase price is going to the real estate too. So now
right,
those multipliers go totally differently because real estate has its own low risk. So the normal multiplier discussion that we're having won't apply to a business like a hotel, which has a large real estate component and some income component to it.
that's actually quite right. Then I think I have to like consider more and looking more on that.
Yes.
And by the way, I just wonder, like when you're looking and investigating the case, would you do it by yourself or do you go it for your team or you outsource this to others like
Investigating the
KPMG?
what?
I mean, you investing the case like you know, like looking at it and then see
Yeah.
which if it's like a good opportunity for you to buy.
Right. So you're asking, how would I verify everything?
Yeah,
Is that
and
what-
with who?
Yeah. So look, the team of experts is very important, and a lot of people miss out on that step
Right.
because they think, oh, attorney is expensive, CPA is expensive, and so forth. But hey, you're going to pay $500,000 or $1.5 million for something. Spend the extra few $1,000s on the expert. You
Right.
specialize in what you should specialize in. So the CEO, CPA, it's their job to check all the figures, all the financial numbers.
Right.
And that, for example, they do an audit. They'll just write letters to all the debtors to the business to verify the numbers that have been declared in the balance sheet.
Mm.
And then they'll evaluate all contingent obligations, like any leases and long-term payments or so forth.
Yeah. And I just wonder, like, with that team that you're talking about, are you onboarding as your own team, or you like outsource this to outside?
No, I mean, outsourcing in the way that you retain people, like how you take on an attorney, you become their client, they're on retainer with you whenever you need their help.
Right. So what you
And then
mean
they
by
charge
your
you for the
team is
services.
going to be like, maybe you work with attorney, lawyer, agency, or office, right?
Right, not agency, but directly with the attorney or CPA and so forth.
Okay.
So what key players would your team consist of?
But that's for me.
Yes.
Yeah, so the key players are a good attorney, a good CPA firm, and also I use, this is unusual, but I like to have a broker as part of my team, and I like to retain a broker from a buyer's perspective, so that broker is looking out for my interest, not only the sellers. So that person is part of my team.
Thank you.
Have we got all the questions? Anybody else? I'm open at your service. I'm not even charging an hourly fee. I'll answer anything you want.
I appreciate that. Thank you. All of you.
Thank you.
Well, I think that I have a lot of questions related to this topic because I'm so eager in this field. But I mean, like, maybe it's not enough time to ask all in one. So I'm just having a question like, can we connect it or have a meeting somewhere anytime that is suitable? Then I would love to learn more from you all.
Yeah, Philip has my contact numbers, my email, and my cell. Please get my information from him. And Philip, I'm authorizing you to share that with her. And you just give me a call and we'll just chat about what I can assist with.
Yeah.
Right.
Trang, I put, and for everyone else, I put my LinkedIn information in the chat, so you can connect with me there, and I'll go ahead and send you Adil's information. I also put a little bit previous in the chat, a little bit more information about our incubator and a time to book. I put my calendar in there, so if you want to book a time and chat more with me, then we could do that as well.
Yeah, I think I have done it.
Okay.
See you in a few weeks.
Perfect. Wonderful. Well, Adil,
Right,
thank you so much for, thank you so much for this insightful talk. It's definitely a little bit different, different from our typical talks, but buying a business, I think, is really a valid, and you make a very strong point. It is very true that a lot of businesses do fail. Why not buy one that already has a current success rate? And I think that it's a very good topic and a very good one to consider when getting into entrepreneurship. So thank you, Adil. Thank you for sharing this information.
Thank you for the opportunity. And by the way, I know that the topic that I'm discussing today might be a little bit controversial. So please don't fire me from this committee, okay?
You're not fired.
It's a starter for right in back of your head, Philip.
I know. Yeah, we're big advocates for those people who I don't think it's really going to deter the people who really want to start up businesses. There's people with a passion, and they may have their own idea, they may have their own invention idea. They just may want to start their own. And there are two different camps of people who become entrepreneurs. There's the early stage founder who eventually gets some sort of venture capital or somehow ends up exiting their company anyway. And then there's the CEO that's hired to manage a business. And those are two different personality types. There's people who love the risk and love to start something, and there's people who love to manage something. And I think that when you're buying a business, it's the person who likes to manage a steady state income stream. And those people who
love to take the risk, they need their head examined.
They do. Yeah, I always try to talk people out of it, but if they want to keep going and they started a business, then we're all in. So game on. All right. Yeah, we will make this recording available through YouTube, and we'll go ahead and circulate that for those of you who attended as well. So anyway, thank you all for attending today, and look forward to seeing you on our future events. We're going to have another event in about 2 weeks, and that's going to be on how to stay motivated for those people who have decided that they want to be an entrepreneur, and how do you stay motivated? Because it is a lot of work. I will not lie to anybody. And there's going to be a lot of times where you're going to doubt what the heck are you doing with your life. But we're going to talk about that in about 2 weeks' time. So stay tuned for that one. All right, everyone. Thank you again.
Bye, everybody.
Thank you.
Happy 4th. Thank you so much. All right. Bye-bye.
Bye-bye.